Jeff, Peter, thanks for joining me today.
It's
Thanks for
great
having
to
us.
see you again, Steve.
Thanks. All right. Topic, credit crunch in office real estate. We're seeing lending tightening, particularly for some office properties from banks. Recent analysis by the Wall Street Journal found that bank exposure to commercial real estate is about 20% of their deposits. That's including indirect lending, which is foreclosed properties, trading portfolios, other assets linked to commercial properties. And banks had really increased their commercial real estate exposure in many different ways. But now they're under pressure to pay depositors more as interest rates have risen, and depositors can go and buy T-bills or get into money markets. And without those cheap deposits now, banks are having less money to lend, and less money to absorb losses, bad loans in commercial real estate. They risk having deposits going elsewhere if they don't pay higher rates. And without those higher rates, they're getting stretched. And they're looking at roughly 900 billion worth of real estate loans and securities, most at interest rates far lower than today's, needing to be paid off or refinanced by the end of 2024. So wanted to kind of get your quick takes on the credit crunch, tightening credit we're seeing from banks, particularly around office properties.
I don't think this is actually really kind of a recent current event as much as it's been happening for probably the last year. We've seen it all around, and I don't think it's really just revolving only around office. I've seen it across every asset class at this point, especially multifamily, where I think the market is, or at least the banks are feeling a wave that's coming soon from all of the deals that need to be refinanced.
Yeah, Peter, your thoughts?
Yeah, well, Jeff is the expert on this. The only other thought I have is the bank exposure goes beyond these offices. The other things that the banks have done is they are depending on brokerage deposits, which are huge. And the problem is, of course, they don't stay in the bank very long. And so, sure, they could stay weeks or what have you, but they could also stay a day. And that creates those deposits are really not good assets for the bank. So not only do they have loans that have to be refinanced that probably can't be, but they also have brokerage accounts sitting on their balance sheet, which really probably shouldn't be.
Yeah, and I think one of my thoughts here is Jeff is completely right. This has been an ongoing issue. It's one we've been able to navigate. It is a challenge. My 2 cents, there is a lot of linkage here to the interest rates. This may create kind of a limit on how much the Fed can really tighten. And if they go too far, this could actually be something that at some point pushes them to making some cuts to allow the banks to be in a better situation. But particularly the regional banks have a fair amount of exposure here. And I do think there's kind of a limit to just how high you can push up rates without starting to run into some systemic issues that could cause the Fed to have to ease.
Yeah, I mean, I think adding to that, you got to give consideration to the bank's cost of funds. Most people are assuming it's strictly related to just customer deposits, but there's other things they can do, lines, credits, things that they can utilize to fund transactions. I mean, there's probably a wave of problems coming. I'd probably almost guarantee it, but it's probably for a little bit different reason than a bank's ability to be profitable and pay returns to investors.
Yeah. Right.
Well, so far, what now we have been seeing for a while tightening. We are not at the moment seeing any sort of systemic risk event, any sort of blowout in spreads. All things worth kind of paying attention to if we do see rates go up much higher, given the bank's situations, especially as they start moving into having that about 900 billion that they're going to have to roll over or deal with coming forth over the next 12, 18 months or so.
Well,
Yeah,
probably
and appraisal values are decreasing, which adds to the complication.
Well, you're probably going to also see a diversification of lenders. It won't be just strictly banks. You'll probably get some more non-depository lenders, that are backed by by funds that are looking for conservative returns, but not, really healthy returns. They don't have to pay market rate, CDs, et cetera. So I think you'll probably see a lot of non-depository lenders pop up because if you're paying similar rates, it's easier to get a loan through a non-depository lender. Why wouldn't you?
Excellent point. I think that's a good point to end on, is that we're already seeing and may see more alternative financing sources, insurance companies being one. And also certainly we're a separate topic, but starting to see vulture funds raising funds that if they do get distressed properties at values, there's investors waiting to swoop in. All topics worth talking about. Thanks for you guys' input.
Thanks.
Okay.